There is a massive number of unsold listings that came off the market at the end of 2024. Is this normal? We're going to take a look at that today. We're also seeing the lowest contract ratio that we've seen since 2009. So, I know last week I talked about how there was some positive indications for sellers. We are still seeing that is a little bit of a rough path right now. So we're going to talk more about that. Let's get into it. This is our active listings chart. And you can see this has just gone downward at the end of 2024, basically since Thanksgiving. But that's kind of normal. We see our listings start to taper off at the end of every year. 2023 was a little bit less sharp. 2022 kind of followed the same pattern. But regardless, what we tend to see a lot of at the end of the year is expired listings, because many of these listings are actually, under an agreement with an agent who has an expiration date, and, December 31st tends to be a pretty popular expiration date, especially if you're listing the house, 3 to 6 months prior than that. So we saw a lot of expired listings come off the market at the end of 2024. Totally normal. But what isn't normal is that it's about double the number that we saw last year. And so the Cromford report was saying, this is a massive number of expired listings. And I think the question is, are they going to be relisted or not? Because we were seeing supply stack up. And now that we have seen, about 900 listings expire off the market, are these listings coming back as we get into January, or are they just off the market because they didn't have success being sold? Now, my question too is, do we have a larger number of listings expiring because we had more listings on the market at the end of 2024 than we did in 2023? That's a possibility as well. So is this something we should be concerned about? Not necessarily, but I will say that I think some of these sellers had a harder time selling than they expected. And when their contracts came due, they just decided to expire rather than extend and continue to stay on the market. Now, as we talk about that, this Redfin article, housing supply just hit a 4-year high, but that's partly because so many homes are sitting on the market unsold. So this article talks a little bit about these stats. Obviously, this is nationally focused, not specific to Phoenix, but active listings, or those total number of homes for sale, climbed to the highest level since 2020 in November on a seasonally adjusted basis, rising 0.5% month over month and 12.1% year over year. They're saying over half of the listings sat on the market for at least 60 days without going under contract, and that's the highest share for any November since 2019, and it's up 49.9% a year earlier, from 49.9% a year earlier. The typical home that did go under contract in November did so in 43 days, which is the slowest November pace since 2019. So this all sounds pretty rough for sellers, but we do have to remember that 2019 was a much more normal market than anything between 2020 until today. So is it okay if we have longer days on market? Yes, but I think a lot of people are still, and I've said this before, are still in this mindset that 2020 to 2023 was a normal real estate experience. And so when your home is on the market for 60 days, it feels like there's something wrong. And that's not necessarily the case. Now, if we look at what the active listing or the days on market is for here in Phoenix, we have a cumulative number for Q4 of 73.36. So, that Redfin article was reporting around 60, and in Phoenix, on average in Q4, it was about 73 days on market. Now, what I do want to point out, however, with the exception of this 2022 to early 2023, when mortgage rates totally shot up and buyer demand fell off the earth, and, we kind of had that really abrupt shift. Aside from that, this really is the highest number of days on market on average that we've seen, above all, even going back to February or January of 2020. So this does track pretty well with what Redfin is saying nationally. That's what we're seeing here in Phoenix, this higher number of days on market, or highest that we've seen. And this has climbed throughout last year. So we've definitely started to see the shift of more listings, more days on market, which is just not as pleasurable for sellers, for lack of a better explanation. Therefore, if you don't really have to sell, maybe you don't want to go through that. So we'll see if these homes get relisted as we're in January. It's a little bit easier to see what the trend is going to be as we get to mid to late January. Right now, it's just too hard coming out of the holidays to know exactly where we're heading. Now, for a little bit of good news, housing affordability didn't worsen in 2024. And I said a little bit of good news because that's it. It's just a little bit. Household earning the median U.S. income would have had to spend 41.8% of their earnings on monthly housing costs to buy the typical home in 2024, which is a slight improvement from 42.2% in 2022. So, we really just went down to 41.8% versus 42.2%, but we'll take it as a win. Affordability improved in 25 of the top 50 metros in 2024. Now, I talked recently about how prices have really come down since the peak that we saw in 2022. So although prices haven't come down to the level that many people wanted to see, we still have seen a shift in price. Now, if we continue to see some price softening, we will see improvement in affordability. And there's a couple ways that can happen, whether that be home prices coming down or we see rates start to come down. So we'll have to see if any of that changes, but at least we're moving in a good direction. Affordability is not getting worse according to this. So we'll take that as a win for now. So let's talk about what's going on with mortgage rates at the beginning of the year so far. And by the way, if any of this is helpful for you, make sure you hit that subscribe button and join us every single Wednesday for these market updates. Here's where we're at. 7.1%. Unfortunately, we are above 7% starting the year. We were in a really good place back in the beginning of December, and now 7.1%, but that's okay. We'll see how things change. We have some new economic data coming out that may change things a little bit. First of all, we're going to be getting the JOLTS data this week. I'm recording this video before this comes out, so you may have that information already. Fed minutes will come out also at the end of the week, which is probably the more important piece of information, is the December non-farm payrolls data. So once we get that, we'll see how that compares to what those expectations are. So it's expected to have added 155,000 jobs, down from 227,000 a month earlier, and the unemployment to hold steady at 4.2%. What's important to know is if any of that expectation is significantly off what actually comes out in the jobs report, that can really affect where the market is going, and then that affects mortgage rates. So that's why we want to pay attention to it. According to Mortgage News Daily, they say hundreds of economists and analysts submit or publish these forecasts, and the median of those forecasts is what is published as a consensus of basically what the forecast is. And so in general, if data suggests that the economy is weaker or inflation is lower versus the forecast, it's good for rates. So if we see a pretty bad jobs report, you might see some movement in a positive direction for mortgage rates. So just keep your eyes on that. We'll see what happens on Friday. But if you're a buyer out there, you may want to stay in touch with your mortgage lender just to find out if any of this market data moves your rate significantly. Now, if you are trying to avoid the whole rate situation, as I've talked about before, you could consider finding a property with an assumable loan. My team has been helping a few buyers looking for assumable mortgages. So check the description below. You can find a link for our assumable loan home search, as well as a guide that gives you all the information you need to know about buying a home with an assumable mortgage. Now, I said that we're seeing the lowest contract ratio that we've seen since 2009. And here we are at 29.3. This is just a little bit less than last time we were looking at it. We were just around 30. And so this is now at the beginning of a month, the lowest that we've seen since March of 2009. What does that mean? Well, the contract ratio is giving us an idea of the heat in the market. How many listings are on the market and available for sale versus how many are already under contract. And right now what we're seeing is a lot are available for sale and not as many of those are actually under contract. Whereas when we were in a really hot market, we were seeing more under contract than were available for sale throughout the entire valley. If we look at the map, as we look every single week, you can see how this is reflected here with each zip code. As I get to the very end of the year here, you'll notice that we actually have one little hot zip code in Tempe, 85284. They only have 25 active listings and 20 of those are under contract. So that is showing that Tempe zip code right now is pretty active. It's pretty competitive because you do have more buyers and fewer listings at the moment. That could change week over week, but I thought that was interesting. We haven't seen a really, warmer zip code in quite a while. And then we still have Chandler over here, a couple different zip codes in Chandler, and then in the West Valley, Tolleson, still on the hot side of things, everything else remaining in that balanced warm market. But as we look at the overall number, that 29 number that I mentioned, that's the lowest we've seen since March of 2009. And a lot of that has to do with the fact that we started to see all of those listings pile up on the market and we haven't seen a lot of them selling. So at the end of the year, we were seeing a larger number of active listings that weren't going under contract very quickly. So the CMI is at 90.7. Anything between 90 to 110 is considered a balanced market. And we had been below 90 not long ago. The Cromford report is saying that we were actually able to increase because of the drop in supply caused by sellers taking their homes off the market during the holiday season. The likelihood remains that these homes will be listed as active again soon. It would have to be more positive. It would have been more positive if demand had increased, but it has not. So the demand index is down from 77.1 to 76.6 over the same month, not down too much, but still going in the wrong direction for sellers to be happy. So that's according to the Cromford report. So as we start to see some listings added to the market, I have a feeling that the CMI is going to go back into the 80s, but we will see what happens. Now, if we look at the chart of every single city, major city throughout the valley, there is a lot of green here. We actually had a really, really positive month over month change at 8.8%. Last week, we saw 6.2%. And it wasn't that long ago that we were seeing a negative percent change when we were looking month over month. So now that we're at the end of this holiday period, we will see what happens. The Cromford report is saying we would expect the supply of active listings to grow again. How long that trend lasts will reveal a lot of how 2025 will turn out. So we'll be watching the supply level very carefully. And I agree with that. So as a seller, I know I didn't have the best news for you today, but you could still check your home value, see if that instant home value is anywhere where you were hoping or thinking it would be. The spring market is always the busiest time for sellers, so that's when I recommend listing your home if you're considering it. On the buyer side, avoid those mortgage rates, look for assumable mortgages, so check out those resources that I have for you. And hey, agents, we are still adding to our team, so if you're interested, send us an email in the description below. I'll see you guys next Wednesday on my next market update.